It's a fine Friday morning. Glad you could all make it to this seminar run by PD Tax, entitled Unlocking Your Business's Hidden Potential During Lockdown. Just wait for a couple more people to join and then we'll get cracking. Well, it's 9:31 now, so if people haven't joined already, they're late. So let's start the ball in motion. So that's me. I'm Paul Davison. For those who don't know me, I'm the Director of Business Taxes for PD Tax Consultants. We're in West Yorkshire. I've been a tax professional for over 20 years and a fellow business owner for over 7 years. That picture of me there was taken 7 years ago when the business first started. I've got Aimee Winterbottom, who's assisted me today with the seminar. So, some initial thoughts really, before we get going. Good wishes to everybody, and I hope everybody's staying safe at this difficult time, and you're all finding ways to keep safe and sane as we're into the 6th week of lockdown. It's definitely a time now to reflect on your business, consider new ways of working, what works in lockdown, what doesn't work in lockdown, what can we all learn. It's definitely a time to build plans for the business so that business is even better once lockdown is released. A couple of housekeeping points. The webinar has been recorded. The tax, so we can watch that on YouTube, pass it to your friends, etc. The slides don't constitute advice. Usual caveat, tax advice must be sought specific to your situation. Don't worry, everybody's muted at the moment until the question stage, when Aimee might unmute a couple of people who ask questions. And this is the first webinar we've ever conducted, so please bear with us. My computer has been crashing a couple of times during webinars, so hopefully that won't happen today. Touch wood, it will be a disaster. So anyway, moving on. This is the timetable. We've got 7 tips, 6 good tips and 1 bad. Well, when I say bad tip, it's not a bad tip, it means something you shouldn't do. We're going to finish somewhere between probably around 9:50. It's not going to be a very long seminar. It's going to be quite quick to the point because you guys are all busy. And then there'll be some questions to be asked. Time for questions afterwards. If you do have a question that comes to mind, please write that in the questions and answers box at the bottom of the toolbar as soon as it comes into your head. And then at the end of the presentation, we'll deal with that question and answer it. If you'd like to talk to us about any of the items mentioned today or anything else, please send a chat on the toolbox, on the toolbar, to the panelists only, not to everybody, with the words follow up and your name and email address, and we can contact you after the webinar to arrange a conversation. Okay, right, so that's the introductions done. On to the first point. Let's have a drink of water. So the first point is a nice and simple point, and it's working from home. I presume that most business owners at the moment are working from home, so that's why I've included it as a first tip. People working from home, it means you're going to incur additional household bills, and there's going to be a disturbance to the family home. So what compensation can we as individuals gain from our businesses in relation to these costs? Well, the first and obvious allowance is the flat rate claim of £6 per week, £26 per month, I think it is, for any staff members who are working from home. So At the moment, it's £26 per month for all staff members. And that can be paid to them by the employer, or they can set it off against their tax bill when it comes to their doing their tax return at the end of the year. That's a nice straightforward allowance. Alternatively, and a little bit more beneficial, but a little bit more complicated, is renting your workspace to your company. So if you're a director, you're owner of the business, one way of taking some remuneration out of your business is by letting your workspace to your company. So if you've got a specific room in your house that is used as an office at the moment, that can be rented by the homeowners to the company for a market rent. As an example, I'm broadcasting to you today from my caravan in Leeds LS17, and this has been my office for the last 6 weeks, and I am renting this to PD Tax Consultants Limited for £325 a month. And that is payable. We pay that every month as a rent, and the company can offset that against its corporation tax. It's a great way of taking money out of the business because it avoids national insurance, and the household expenses that are associated with the room you rent, or in my case, my caravan, can be offset. A proportion of those costs, like mortgage, interest, rates, heating and lighting, all those types of things, Wi-Fi, can be offset against the income that you receive as an individual on the rent you receive. So it's a nice little way of taking a little more money out of the business. We just published a blog on this on our website. If you want to have a look at our website, probably on LinkedIn as well for more details. But it's just a couple of two important points just in terms of implementation. The first important point is, if you do this, make sure you keep something personal in that room that you're renting, because if you don't, there's a risk you'll lose your capital gains exemption when you sell, or a proportion of it, when you sell the property as a home. And make sure that you do set up a license for the rent. So a proper written license between the company and you personally. We do have some pro formas of that if you want to get in touch with us after this meeting. Okay, on to number 2. This is quite a well-trodden route. It's about the financial supports available. Furloughing at this time of during these economic difficulties. Employing furlough employees, obviously you can get 8% of the wages, pension, employers' national insurance. Important to get the paperwork right in terms of telling your staff what's happening, because they might be brought back to work. We might rotate them. Some people might be made redundant. So get your paperwork right and make sure your house is in order when it comes to documenting what people are doing, because if HMRC come and looking at your records post-lockdown, it's important that you can evidence what's happened. Council grants. Council grants have been sent out, £10,000 for normal small businesses, £25,000 for pubs, etc., that type of thing. Those council grants are subject to corporation tax. Just bear that in mind. VAT payment deferrals for the current payment quarter. Make sure that you cancel your direct debits, because once you've paid it, it's too late. Your personal self-assessment payments on account need not be made at 31st of July this year. So don't matter where your income's from, you don't have to make your payments on account. There'll be no interest and no penalties if you don't make those payments. Time to pay applications. If you can't afford to pay your corporation tax or your pay as you earn, or it's difficult to pay them, you can write to HMRC or call them, but these applications have to be specific, and you have to set out a plan to them as to when they will be repaid. The business interruption loan scheme, obviously had some difficulties with that. Banks have struggled to facilitate it. So they decided to bring in the bounce back loans arrangement, which is due to come in next week for applications, up to £50,000 for small and medium businesses who have been adversely affected. Now that is a interest-free loan for a year and no fees. But a lot of people are saying, that I've been talking to, are saying, is this going to happen? Because it's going to be fairly well open to fraud. It's going to be a lot of security. There needs to be a lot more securities in place before banks start to realising money in this manner. So I think people are thinking this might not happen as soon as businesses might want. Okay, so that's the financial support that's available. If you or your clients are making losses, what can you do with those losses? Well, you can carry back that loss for up to a year against previous profits to get a tax refund of tax that's already been paid on that profit. So if you are thinking about, if your company or your clients are making losses, it's going to be very important that you get those corporation tax returns in as quickly as possible to get that refund of tax. It's also worth thinking about any, in personal, made any personal tax losses last year. If you made any pension contributions, which might give you a tax refund because you paid pay as you earn, then get your personal tax returns in as soon as possible as well to get those tax refunds. Now, if you are still to pay corporation tax on a prior year where you've made profits, but you believe in the current year that there'll be a loss, which you could offset against that profit, then it's worth, I think, writing a letter to HMRC to say that actually there's a loss in the current year, so you don't propose to pay the relevant proportion of the corporation tax for the prior year until the loss is sorted and settled. I think they will be quite understanding when it comes to that type of thing, but as long as you tell them, write to them, that should be okay. During the credit crunch of 2008, HMRC did change the rules so that losses could be carried back for 3 years rather than just 1 year, so you could get a better refund of tax. There's no notification of something similar to that yet. We might hear something like that, we might not. Any losses that you can't carry back for 1 year, you can carry forward to future years. Okay, another quite straightforward concept. This is the concept of protecting any valuable assets that you have in your trading company at the moment, or your client's trading company. So if your trading company owns land and buildings, or listed shares and securities, or has cash which is in excess to working capital, or it has any trademarks, patents, intellectual property, it's worth thinking about how we can protect those assets if there's a risk, if there's a higher risk to the trade from creditors or from whoever during the current economic situation. So to protect those assets, you could consider setting up a holding company above the trading company, so that you as the business owner or your fellow shareholders own the holding company, and the holding company owns 100% of the trading company. Insertion of the holding company can be done tax-free if HMRC clearance is obtained. Once the holding company is in place, then what you do is you then distribute up the asset from the trading company to the top company, and make sure the paperwork's in place. So if it's a land and buildings, trademarks, make sure the transfer documentation's in place to register those assets with Topco. It's all important in terms of the protection that you need. It's important that it is done as a, it's important that it is done, oh, sorry, go back, press the wrong button there. It's important that the transfer is done as a dividend, because that distributes those assets, those reserves up to Topco, protecting the asset from the creditors. And you'll need to make sure that your trade code's got sufficient reserves in it to facilitate that distribution, to make sure you've got full protection. Okay, a number of clients have been doing that quite recently. Here's quite an interesting topic. Private company share values may be low. So what does that mean? Well, the current economic uncertainty means that companies are generally not worth as much as what they were. The markets are all over the place. Deals aren't happening. People aren't buying things. So it's a totally different time when it comes to the markets and buying and selling companies. And what we're hearing and we're thinking about is that actually, normally going on a historic basis, companies are being valued on a price earnings basis. So looking at how the performance of the company over the past 2, 3, 4 years, what's the maintainable earnings, and timesing that by a relevant multiplier. But those types of methodologies are coming under scrutiny now, because what we're seeing is there's so much uncertainty that historical profits are now less relevant in calculating values. So what we're looking more to is a stronger focus on budgets and on discounted cash flows re market situations. So look at your budgets. What do you expect to happen in the next 6, 12 months? You might not be able to go past 6 months because of the uncertainties, and that all goes to show that things are worth less at the moment, potentially, when it comes to tax anyway, because taxes, when it comes to valuations, generally we want a low valuation for moving things about from a tax point of view. So actually what that all means is restructuring, doing things with equity. It's quite a nice time to be doing that right at this very present moment. So how can we take advantage? Well, the most obvious one really is staff incentives in relation to equity. Because what we want with the classic EMI share option scheme is to have low values on inception. The lower the value on granting the option, the more tax efficient the option will be over its lifetime. So EMI share option scheme is really good at the moment for most businesses, because we should be able to agree a fairly low valuation with HMRC, which gives the employee a better result when it comes to their tax position. So yeah, EMI schemes, great. Any other restructurings could be of use as well. Often we want to sort of move things around. Things like succession planning, moving things down the chain to the children, whether lower values make things easy generally. Although property, often if the succession planning involves a property company or property portfolio, that's probably not going to be affected that much at the moment, the valuations, but they will. But some like holiday accommodation might be affected, and it might be easy now to shift things about and move down to future generations. Also, general restructuring, demergers. Sometimes values do make a difference, things like stamp duty. Sometimes you can't get a relief for that little thing you want to do with that share, move it to a holding company or whatever. And so therefore, having a lower value makes things much more palatable when it comes to tax. So cash flows and mothballing. Make sure you do your cash flow projections. That's, I think, quite key in terms of managing the business, understanding where it's going. And taxes, as you've seen from the second slide, the second point, well, you know, a lot of taxes at the moment can be deferred and put back in your cash flows. So that's worthwhile bearing that in mind. But if you do a cash flow projection and you are putting that big VAT bill you've got from June back to the start of next year, make sure you do your cash flows right through to that VAT payment. So you've got it, you know that you're confident that you can actually pay that VAT bill when it becomes due. Make sure you've got ability to flex the budget on a monthly basis, and flex your assumptions and bring in the actual figures for balances, etc., for the next month. And make sure you're realistic with your projections. Nothing worse than being optimistic and running out of cash, because we all know that cash is king. So obviously there's been some issues in mothballing. Some businesses are being put into wrap for the moment. Can a business owner furlough themselves? They probably can, but you need to be careful what you do, because you can run, what you shouldn't be doing is developing the business or doing the work. You can be doing the corporate governance stuff around it. But if you do furlough yourself, make sure you keep records of what you are doing and what you aren't doing, so that if HMRC come around, you can be confident. So what costs can you negotiate on, and what costs can you defer? Okay, so the next tip is the last tip, tip number 7. So if you would like to speak to somebody at PD Tax after the meeting, please send us a chat with the words follow up and your name and email address, and we'll contact you after the webinar to arrange that chat. Okay, and then finally, tip number 7. So this is not a bad tip. It's basically, don't do nothing about tax. There's a lot of deferral in tax, and the government are throwing a lot of money around. But when it comes down to it, don't take your foot off the gas and think that the government will be lenient on tax when lockdown is over, because they probably won't be. And they'll probably be thinking, how can we recoup as much of this money that we spent as possible? So it's really important now it's a good chance to revisit your business and its finances, and make sure you're doing all you can to get it watertight from a tax point of view, from a legal point of view, and from an accounting point of view. So I've just done a quick checklist really of things. Are your company's house filings and statutory books up to date? A lot of people's statutory books aren't up to date, and it's worth just thinking about that as corporate governance becomes tougher in the UK. Are your accounting systems fit for purpose? Or are they something that, do you do your accounting the way that it's always been done? There's no doubt that frequent and up-to-date numbers are key to any successful business. And how are those numbers presented? Do you think, well, actually, that's not quite presented in the right way, and the gross profit's not quite worked out properly? If that's something to think about, then do something about it now. Revisit your numbers. How are they presented? Give you the best chance of getting the most information about your business. Are you confident in your payroll and VAT systems? Is there anything niggling in your brain that you've been thinking about? Is that right? Am I doing that VAT scheme right? Are the pay-as-you-earn people doing my payroll right? Definitely worth thinking about that now. And are your corporation tax and personal tax returns up to date? And are there any sundry returns to be filed? For example, employment-related security returns. An employment-related security return would be needed if somebody gets shares in your company, or you get shares in another company that's associated with your existing company. Right, so that's my 7 tax tips for the current climate. I hope there's been at least one thing in there that's helped you out with your business or your client's business. Are there any questions, Aimee, that we can answer at this stage?
Yeah, there's a few questions. Firstly, thanks for that, Paul. I know I'm a bit biased, but I found it very useful.
Oh, thank you, Aimee.
So the first question is, so you mentioned the £6 flat rate being paid to employees, but how do business owners reclaim the £6? Is it reimbursed by HMRC or deducted from profits, for example?
I think it could be either way. I think, generally speaking, you would probably want to pay it yourself. So if you're a director of a company, just do a normal sort of expenses claim, and then put that expenses claim into the accounts department, and the accounts department can pay that. That's the best way of doing it, because you're getting money out of the company. You can set it off against your tax bill, but generally speaking, I think you'd want to pay it yourself.
Okay, thank you for that. The next question is from Amanda Ryder. Says, can I lend money from my trading company to my investment company so the money is protected, i.e. via an unsecured loan?
That's a good question, Amanda. You can do it, but the loan is then an asset of the either TradeCo or HoldCo. Excuse me, my phone's just rang. Just get rid of that. Just turn that off. You can lend money. Money can be lent from TradeCo to Investment Co. If you think that through, the loan is then an asset of TradeCo. So creditors of TradeCo could still pull in that asset if they wanted to. It's still an asset of the company, which could be used for creditors. So it's not protecting that loan. Obviously, by lending the money to PropCo, Investment Co, you are moving the asset that's going to, the actual cash or the property or whatever, to a different company. So it makes it harder for the creditors to get at, but it's not as effective as moving it up to a holding company. What you could do is you could set up a holding company or a trading company, move the cash up to the holding company, then the holding company could lend to the property company. Or we could have some sort of share arrangement whereby PropCo has maybe a income share in TradeCo. So we can move dividends up from TradeCo to PropCo without a loan being in existence. If you want to discuss that later, Amanda, then please let us know and we can help you out with that question.
The next question is regarding the bounce back scheme. Gary Kaplan said, is there any thoughts on what undertaking in difficulty might mean?
Good question, Gary. I was thinking about that. I don't know is the answer. I don't know whether there's going to be any more detail on the bounce back scheme until Monday. I was thinking of, for instance, in relation to my business, our business, PD Tax, our business has been adversely affected. The number of new leads, new clients coming in is definitely reduced in the current climate. The financial situation at the moment is still quite relatively good in PD Tax, but in May and June it might not be so good. So we are suffering from the start of a drop, and whether that's enough to get the bounce back loan at the moment, I don't know. I think obviously the devil's in the detail, and I think adversely affected is probably going to be quite wide, because they're probably going to want a number of businesses to be able to benefit from this. But like I said in my in the slides, they will need to be careful because of the risk of fraud.
Okay, one final question. In relation to protecting valuable assets, what are the reasons HMRC would deny clearance typically?
That's a really good question. Is that one of our planted questions, Aimee? Has somebody asked that question?
That is my question.
That's your question, eh?
Yeah.
Well, that's an excellent question. In relation to the insertion of the holding company, the protection of assets. So if there's a property in the trading company and we're worried about that property and we want to move it up to a topco, then the commercial reason of protection of that asset is always going to be one which HMRC clear. So that's the main reason you would have a holding company. Well, the reasons you would have a holding company are to protect valuable assets, to set up some sort of a group arrangement whereby the group set up a group for, like, you have different businesses within that group, different niches within certain trade or whatever, and you have a group structure. So what they might not clear is if you want to start to use a holding company to manage dividends. So as an example, we had a client recently who was a trading company, and there was 2 shareholders in that trading company. One of the shareholders owned their shares in that trading company via his own personal holding company, and the other one didn't. So we wrote to HMRC to say, please could the other shareholder insert a personal holding company into the arrangement so that he can manage, effectively, he can manage his dividend rate. Because what you can do then is you can move the cash out of the trading company into the personal hold company, and then distribute it tax efficiently to husband, probably, and wife over the years, rather than just take it all out in a one and pay a high rate of tax. And HMRC didn't clear that. So they don't like it if you are doing it to manage your tax rate, would be the current situation.
Okay, thank you for that. And that's everything.
At the end of is there any more questions of that? That's us, is it, Aimee?
Yeah, that's us done.
Right. Okay, everybody. Well, I hope you've enjoyed today's seminar. You've learned something, at least one thing. If you've learned one thing, then we're happy, and hopefully you'll be happy. And then have a great day and a lovely weekend, and see you soon. Bye.